Well, hello, and thank you for joining this afternoon. I thought we'd try something new in terms of reaching out to you today. The intent here, obviously, is to keep you informed of what's going on in the markets and what our thoughts are and how we're reacting to what's taking place. Let me set the table for you first here a bit about what has transpired and what it's led to in regards to where we are in the marketplace right now. As you're all aware of Trump's rolling out of tariffs, President Trump's rolling out of tariffs last week on Wednesday, his inauguration day. What do you call the plan? I can't remember off the top of my head. But the rollout of his tariffs were much more extensive than Wall Street had expected. I think of the idea of them being reciprocal. While Wall Street was not pleased with it, I think there was some level of anticipation that was what we were going to get. What we got was anything but reciprocal tariffs. As you probably saw, the tariffs were really more based off of trade deficits than they were actually reciprocal tariffs. And it sent the market into tailspin. We had 4 days where we literally lost 12% the market value and wiped out over $6.5 trillion in investor capital. It's the type of sell-off we have not witnessed or seen since COVID, really. And that was followed by a huge rally on Wednesday, almost 10%, about 9.5% rally on Tuesday, and then followed by a sell-off on Thursday. Now that rally that I referred to on Wednesday, the 9.5% rally was based off of the president rescinding or at least pausing his reciprocal tariffs for 90 days. And the rationale for that, the meaning, the rationale behind him pausing, has nothing to do with countries coming and claiming to be negotiating, and everything to do with the markets we're breaking. We talk a lot about the markets and the 12% decline that we saw, but equally important was the bond market was beginning to lose confidence and lose faith, not only in America, but certainly in these policies. And we had a significant move up in Treasury yields. And why that's important is bonds, particularly 10-year Treasury bonds, is the baseline that's used for so many other instruments. The easiest one that we think about is mortgages. Your mortgage on your house is set off of the 10-year Treasury bond. So having Treasury bond yields rise dramatically increases the probability and risk that something else in the market or economy could break. So let me just run through some of the numbers of where we finished. Yada, 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 yada. Okay, so where does that leave us now? Well, as we saw after the walking back of reciprocal tariffs on Wednesday, the markets began to exhibit more weakness. And I think this is an important, critical point here, is that the market environment right now feels like we're in a bear market period. Usually a bear market, its definition for a market that's dropped 20% or more. It's real, in terms of coming from peak to trough. We never closed there in this cycle, but we did trade down there one day this week. But the activity that we're seeing now, the unwind of the bond market and equity markets, is that I don't think we're quite done yet. I think we could continue to see some increased volatility. And to be honest, I wouldn't be surprised if the equity market bled lower. I can't predict or know with certainty if that will happen. Nobody can. It's really just a guessing game. But I do suspect that this is not over yet, and that we will continue to have some weakness in the markets for at least for a little bit more of a foreseeable future, as this administration figures out what the right policy is going to be.